Hi, everybody. I'm Rick Edelman. Thanks so much for joining us today on this really very cool webinar, very different from what we have, I think, ever done in our webinar series. Crypto Outlook Q4, and frankly, into 2025 as well. What you need to know now, what's going on, what's going to be happening next, and to help us understand all the above, very happy to bring on to our webinar Matt Hougan. He is the CIO, Chief Investment Officer of Bitwise Asset Management. Matt, great to see you again. You're
Great to
on
be
mute.
here, Rick. Thank you so much.
Matt was just at Future Proof in California. He just finished the Barron's Top 100 conference in Florida, on his way next to London. You're the traveling man, as they say. So thanks for doing this in the meantime. Matt, you may well know if you've been in this space for any length of time. He was the CEO of ETFs.com and wrote, along with others, the CFA Institute's comprehensive guide on ETFs and cryptos. And so he's been in this space for a really long time in the crypto and ETF world for decades. Matt, tell us, for those who may not be as familiar, a little bit about Bitwise.
Sure, absolutely. Delighted to be here. Delighted to break new ground in this format with you, Rick. Bitwise is a specialist crypto asset manager. Crypto is all that we do. We were founded in 2017, have been managing money on behalf of clients for more than 7 years. Today, we manage around $5 billion in assets in the US and in Europe. You can see us here ringing the bell at the New York Stock Exchange for our Bitcoin ETF, BITB, one of the largest Bitcoin ETFs on the market today and the lowest cost large Bitcoin ETF that exists. But what really sets us apart is what we're doing today. We're really focused on educating people about the crypto market. You mentioned co-authoring the CFA Institute's Guide to Crypto. I know we're going to run through some of our quarterly report. Our view is that if we can inform advisors about what crypto really is, look past the headlines and evaluate data and facts on the ground, they'll get comfortable with crypto, possibly build an allocation, and hopefully many of those will work with us. So that's what we do at Bitwise. We've been doing it for 7 years.
One of the big distinctions, among so many others, at Bitwise is that you have dozens of professionals who work regionally across the country directly with advisors. The support team you've built is unprecedented in the crypto world.
Yeah, that's exactly right. I think we're the only major crypto asset manager with a full distribution team in every region of the country. So no matter where you live, there's someone in your neck of the woods ready to answer the phone, whether you call on Monday or on Saturday evening. If you have a client who has a question about crypto, we can help you answer that. That's really important for advisors because it's one thing to allocate to crypto. It's another thing to own it through ups and downs, through various news cycles. You're going to get inbound questions, and we're proud of this distribution team that we have that exists there to support the advisors out there who are on the front lines considering allocations to this new, exciting, but still developing asset class.
So there is so much interest, curiosity, and opinion about crypto, and yet a dearth of knowledge and understanding about it. Bitwise produces a quarterly report on what's going on, what's coming next. We're going to share with you highlights of the Q4 report. We'll give you an opportunity to download the entire report at the end of this webinar. But what we're going to do here, we've never done before. I generally hate PowerPoint-based programming because it's death by PowerPoint. It's a joke in the speaking circuit. But these charts that Matt is going to share with us are profound and will give you a really important in-depth understanding of what's going on. It's about 32 charts, if I counted them correctly, Matt, and you're going to blow through them in 30 minutes. So you get 1 minute per chart on average, and I'm going to try to hold you to that because we're then going to open it up to questions. So as you come upon a question from something you see in one of these charts or something Matt offers, you can go into the Q&A box here on Zoom. I will curate that at the bottom of the hour, and we will tackle as many of your questions as we possibly can. So here we go, Matt. There's your first one.
I love it. Yes, this is like sitting next to me with the quarterly report going through every slide. What you're seeing on this page, of course, is a comparison of the return of major asset classes on a year-to-date basis. And the TLDR here is that top line is the Bitwise 10 large cap crypto index. Crypto is the best performing asset class in the world this year, up 40% over the first 6 months. It's actually up more now. That compares to, a 15% return for US equities. Gold, which is grabbing headlines, up maybe 13% through this period. Maybe it's up 18 or 19%, and everything else below that. What I love about this chart, Rick, is there is a little bit of sort of depression in the crypto environment right now. People are sad about this market because it's been, 6 whole months since we've set a new all-time high. And the message I think this chart brings is just to hold on a second, step back. Crypto is doing just fine, right? 2 years ago, we were dealing with FTX. Today, we're dealing with BlackRock. I think when I checked earlier today, Bitcoin is now up 50% for the year. It's up 132% over the last 12 months. Crypto is doing very well indeed if you pan out just a little bit. That's what I take from this chart.
And that's not what people are generally hearing, as you pointed out, because it's been what people would argue it's been relatively flat since March, which is not really the full story. So good info. And here's chart number 2.
Yeah, I like this chart a lot. This is looking at the 10 largest crypto assets and their return over the first 6 months of the year. That dark black line in the middle is the index. So anything that outperformed the index is sort of at the top of the chart. Anything underperforming it is below. It's not that important to me, the exact return of every line. I wouldn't focus on that. What I would focus on as an advisor looking at this is that the return is remarkably different. There's this belief out there that all crypto assets are perfectly correlated, but these are the largest 10 assets, and you're looking at, what is that? A 70%, 80% dispersion of returns over the first 6 months alone. Crypto assets are going after different markets. They're succeeding at different rates, and you need to decide which one you want to allocate to. You can't just pick one of 10 and assume they're all the same. And I think this chart really hammers home that dispersion of returns that you get in this market.
Well, and this shows you the broader 4-year cycle.
Yeah. This chart we've been sharing since 2022. So back when it was painful to share this chart, Rick. But this is looking at the return of Bitcoin over I guess it's 13 years. What you can see is that there is this 4-year pattern. So 3 big up years and a pullback year. 3 big up years and a pullback year. The reason we're showing this now is we think this pattern is repeating, right? So again, we started showing this in 2022. Since then, we've been on track. We had a great 2023. I would say we're on pace for a fantastic 2024. And everything tells me that 2025 is going to be exceptional. Now, importantly, why does this pattern exist? Many people assume it's related to the halving. It's actually not. It's not synchronous with the halving. What I think this is a classic bull, boom and bust economic cycle. Every one of these cycles, Rick, starts with a major breakthrough. In 2011, it was the ability to trade Bitcoin. That brings in lots of investors. You get a lot of hype and excitement and venture capital. And eventually, it gets over leveraged and overinflated, just like the economy does. And then you have a contraction. And then you have another breakthrough. 2015, the Ethereum cycle. Ethereum was created. The same thing. You bring in more investors, more venture capital, leverage builds up, and then a reset. This is a natural economic cycle. People always ask me, will this kind of boom and bust cycle repeat? It's been repeating in the traditional economy, just at a smaller scale, for hundreds of years. I suspect it will continue to repeat. Will it be exactly 4 years? I don't know. But we're not yet at the, aggressively over-leveraged, aggressive VC capital phase. In fact, leverage in the system is extraordinarily low, which tells me that there's a lot of dry powder to see the kind of year 3 returns that we've historically seen in these cycles.
Some people have argued that we are in a new era of sorts in the crypto space, meaning institutional engagement in a level we have never seen before, and advisor engagement, thanks to the ETFs that we have not seen before. And the question is, will the introduction of, I'll say, Wall Street, the advisory marketplace and the institutional marketplace, alter that 4-year cycle's behavior?
Yeah, I think that's a really good question. It's certainly a different type of buyer that allocates in a different way, and it's a potential huge flood of capital that could paper over or at least extend this boom and bust cycle. So I guess my answer would be I wouldn't be that surprised if this cycle lasted more than 4 or maybe 5 years because you have this wave of capital coming in. But if you're asking me, Rick, if we'll never have a major pullback year again, I think the answer to that, unfortunately, is no. This is still a new and developing asset. Of course, you're going to have booms and busts, but could this boom last longer than previous ones because we have trillions of dollars of capital that needs to get exposure to crypto? I think that's a reasonable hypothesis. What I feel comfortable with is we haven't hit that peak of over leverage and over investment, because if you look at the data, the leverage is just not there. The investment is just not there. So I still think we're early in this cycle. You might be right. It might extend to 4 or 5 years. That'd be wonderful. I don't think it's going to be shorter. That's what I feel pretty good about.
Got it. And looking at all the green numbers, I don't see any pattern in terms of whether the trends are growing or shrinking. Do you see any pattern at all? Can you try to predict, not can you, would you effort to try of what the next green box or the next two green boxes are going to look like based on how they've performed in the past?
No, I don't think
I
that
don't see anything.
I don't think there's any way to know that. I
Yeah.
think when I think about it, I think about the fact that institutions own 79% of US stocks and they own what, 4 or 5% of Bitcoin. I raise that because I don't know what that next green box is, but if this is truly the mainstream cycle, if this is the cycle where institutions come into the market, there's a huge amount of capital that needs to come in. And so it'll be fun to see what those boxes turn out to be.
And here's a whole bunch of more boxes.
So many boxes. I love boxes, Rick. Look, unless you have eagle eyes, it may be hard to read all the letters and numbers on this, but what you can see are the colors. And what this is a classic sort of quilt exposure of asset classes ranked by year from 2011 to 2024. And you see here something similar to what you saw on the past, which is Bitcoin has big up years and big down years. What this chart tells you specifically is if you look at the top like 7 or 8 asset classes, Bitcoin has always been the best performer in the market or the worst performer. There's no Mr. in between. And right now we're trending toward the best performer. We're the best performing asset class in the world this year. Um, I don't know. I like this chart. It makes me very bullish for where I think we may be going in the future.
And this is why you're going to want to download the report when we send you the link at the end of this webinar so you can actually peruse this in greater detail than we are here on screen. This one's simpler and easier to see.
Yeah, absolutely. What we're looking at here is the price of Bitcoin, and we have these vertical lines that denote the halving. Now, I mentioned earlier that the 4-year cycle, I don't think is reflected in the halving, and you can see that here. It's not the case that Bitcoin goes straight up after each of those drop down lines. But as you know, Rick, the halving does have a major impact on the market. The halving, of course, is the quadrennial, every 4-year event where the amount of new Bitcoin being issued falls in half. And what you see from this cycle is that that typically precedes with some sort of lead time a dramatic bull market in crypto. And that makes sense. Less supply, same amount or more demand should cause the price to go up. And so we're actually tracking just fine for a typical halving so far. We've been chopping more or less sideways. That's pretty normal for the first few months of a halving. Over time, historically, this reduced supply has contributed to strong returns. Will it happen again? I think it might. Others might take what they want from it, but I do think it's an important factor in the market. This slide tries to capture that.
Correlation in every survey I've seen of advisors is the number one reason advisors are interested in Bitcoin. It's not the returns. It's because of correlation, which aids in MPT statistics. This highlights that really well.
That's exactly right. I do think that's the most important characteristics when you're considering crypto in a portfolio. And what this chart is showing in that green shaded box is that Bitcoin's correlation to everything else, stocks, international stocks, emerging market stocks, commodities, REITs, bonds, it's effectively zero. It's at least very low. And that makes sense from an intuitive perspective. If you think of what drives Bitcoin, Rick, it's not the same thing that drives stocks. What drives Bitcoin, regulatory progress, monetary debasement, the passage of time, institutions coming into the market. What drives stocks, economic growth, tax policy, technological breakthroughs like what's happening in AI. Those are just different factors. And you see this expressed in low correlations. This is important because even though Bitcoin itself is volatile, and we have some slides on this later, as you know, if you add a non-correlated volatile asset to a portfolio, it doesn't increase the volatility of the portfolio as a whole. You can't think about Bitcoin in isolation as an asset because you don't hold 100% Bitcoin. That's like thinking of cayenne pepper in isolation as an ingredient, right? You wouldn't eat a plate of cayenne pepper. Most advisors aren't having their clients eat a plate of Bitcoin. It's a non-correlated asset that can boost risk-adjusted returns historically in portfolios because of this correlation that you see here. All right, I can dive right into this one, Rick. I come from an ETF background. I love ETFs. The Bitcoin ETFs were the fastest growing ETFs of all time, pulled in 17, 18, $19 billion of assets. They're pulling in more assets by the day right now. What this is looking at in the left is the number of Bitcoin that have been purchased by US spot Bitcoin ETFs since they launched in January, 247,000 through June 30th, versus on the right, the number of new Bitcoin that have been issued by the Bitcoin network over that same time period. What you see here is the Bitcoin ETFs are purchasing 2 times the new supply. In other words, they're gobbling up all of the new Bitcoin that exists, and then they're having to source another 124,000 Bitcoin over this time period from existing holders. In the long term, Bitcoin's price is determined by supply and demand. What this chart is getting at is if we continue to see heavy demand for US spot ETFs, the supply isn't going to respond to that. The supply is inelastic and it's fixed. And that supply demand imbalance is looking very favorable for Bitcoin right now.
And I think that this is only the very beginning. I think we're going to turn around in a couple of years, and that number on the left is going to have another zero, because all the surveys are telling us that the current level of adoption, not the rate of growth of adoption, but the current amount of adoption, the number of advisors currently engaged is still very, very low, as everybody is still getting educated and learning about all this. And as the major wirehouses are beginning to complete their due diligence efforts, Morgan Stanley ahead of the pack there. And once they all come online and you have hundreds of thousands of advisors representing millions of investors and tens of billions of assets, we're going to see far greater inflows than the historically strong numbers we've seen to date by a factor of 10. And the number on the left is going to become 2.4 million. The number on the right is going to remain at 120 grand.
I think that's really right. I was just speaking at the Barron's Top 100 Advisors Conference, and the room was full of people from Merrill Lynch, from Wells Fargo, from UBS. Those people can't buy Bitcoin ETFs yet. It's not even approved. It's approved in a limited fashion on Morgan Stanley and the other largest wirehouses. It's not even approved yet. When that happens, I think you're right. I think we are adding another comma to the number on the left. And as you mentioned, the supply doesn't budge. It's inelastic. It's set in time. We know it exactly. And it's hard to look at the supply demand dynamic and not be relatively bullish for where Bitcoin is going.
Let's talk about futures.
Sure. This is just another important view. What we're looking at is open interest and volume on Bitcoin and Ethereum futures at the CME. And obviously this chart is up and to the right. You don't need to worry about the details here. What you should take away from this is that institutional adoption of crypto is happening. Now, if you think about the Bitcoin ETFs, they just launched in January, and we're seeing strong inflows, and you and I think those inflows are going to accelerate. Before the Bitcoin ETFs, the CME was where institutions got regulated exposure to crypto. And the futures launched many years ago there. They're now hitting their stride. They're now going parabolic in terms of demand. And it's just a lesson that institutions take a long time to adopt to these new capabilities, but they eventually come. And I think ETFs are going to follow the same format. Everyone was excited for the demand for these futures when they first launched. It wasn't nothing yet, right? It was only after they'd been on the market for a few years and people got comfortable with them that it started to really accelerate. And you're seeing that in these charts.
So in the beginning, what the futures predated the spot, and you had futures ETFs before you had spot ETFs. A lot of people were buying the futures ETFs as the only way to gain access to Bitcoin, even though it was indirect in an ETF format. Now that the spot ETFs are available, do you see any reason why advisors would choose the futures ETFs over the spot ETFs?
Effectively no is the answer. And,
We've already had one ETF provider cancel its futures ETF because of that fact.
that is correct. I mean, the spot ETFs are lower cost and they have higher fidelity to the price of Bitcoin and Ethereum. I could go into a complex tax argument about short-term positioning, but let's not do that. Most investors are better off in these spot products than in the futures products. That's just reality.
And I don't think that's a particularly unique conversation to crypto. I mean, you say the same thing about stocks too.
And gold, indeed, there was
Yeah,
gold futures ETF before there was a spot gold ETF, and now all those have closed. This is
yeah,
a well-worn tale.
yeah. Let's talk about blockchains.
Sure, absolutely. This is really important. One way to think about what blockchains do is that they sell space on the blockchain, right? Blockchain is a database. In order to use that database, you need to pay fees, and they sell space on the blockchain. For Bitcoin, it's processing transactions. For Ethereum, it's processing activities. What this is looking at is the revenue that leading blockchains are generating. And the primary takeaway from here is that A, they generate real revenue. We're talking about billions of dollars a quarter. And B, Ethereum generates the bulk of it. Ethereum is the most popular blockchain from a revenue-based perspective, right? It has a different economic model than Bitcoin. Bitcoin is not trying to produce revenue. People are just using it. Ethereum is, and I would say it's doing pretty well, right? It's done $1.6 billion year to date. This is not nothing. This is real money. People are paying to use these chains. Now, you will see it's not as high as it was during the last bull market cycle. That's worth noting as well. Ethereum is not at all-time highs either. I think those fee revenues are going to grow over time, but it's worth keeping this chart in mind. There's real revenue in this ecosystem. All right. Another look at activity in Bitcoin and Ethereum. I would focus on that chart on the right. It's the most applicable chart. This is the number of daily active addressers in each ecosystem. A daily active address in Bitcoin will be sending Bitcoin to someone. I don't think that's a particularly important statistic because you might buy and hold Bitcoin and you won't be active for years. In Ethereum, it's the number of people doing transactions on Ethereum. Remember, Ethereum is what all DeFi apps, stablecoins, etc., are built in. And what you see from this chart is something really interesting, which is A, the number of transactions is going way up, and B, the chart is getting different colors. Now, why is it getting different colors? Well, Ethereum, as you know, Rick, is a blockchain that can only process a certain number of transactions and charges relatively high fees for that. As it looks to scale, what it's been built out are what called layer 2 networks that process transactions at a lower cost and higher throughput on behalf of Ethereum, and then periodically post them back to the Ethereum ecosystem. And what you see on the chart is the use of those layer 2 solutions, Arbitrum, Base, ZK Sync, Optimism, etc., is just going exponential, right? This is the kind of chart that crypto VCs want to see, or that VCs in any technology ecosystem want to see. It's showing rapidly increasing demand and utility for Ethereum's service. And it's one of the most optimistic charts in crypto when you're talking about Ethereum specifically.
And I know someone's going to ask, so let me preempt it. If we were to put Solana side by side, what would that bar look like?
Yeah, Solana has been doing great as well, like hugely scaling activity as well. I think both Solana and Ethereum are going to be very successful. I think they're going to be successful for different reasons. I think Ethereum is going to be the primary blockchain for high value financial transactions, and Solana is going to be the primary blockchain for lower cost, higher throughput transactions. It's certainly winning in things like the DPIN category, seems to be migrating over to that space. I think they both can be successful. I don't think this is a Google versus Ask Jeeves situation. I think it's more a Apple versus Android situation where you can have both succeed and serve different use cases in the market.
This is
All right.
something that I don't think most folks really pay a lot of attention to, that there are human beings behind these blockchains making them work.
That's exactly right. And building things on them. Yeah, on the left, we're showing the average developer count by ecosystem of 5 of the largest programmable blockchains. And on the right, the number of applications built on those blockchains. So there are thousands of people who wake up every day and are building applications on Ethereum. That's how we get things like stablecoins. That's how we get things like Uniswap. That's how we get things like Polymarket, the presidential election odds betting market that's sort of taken the world by storm. There are real humans doing this. I wish that chart went further, because if it went further, you would see that the number of developers building in this space is up substantially from the last sort of era of the bull market. It's down from the peak, but up substantially. The takeaway from the slide on the right is just to emphasize that Ethereum has a substantial lead in this ecosystem. I will say that right now in the market, Rick, a lot of people are excited about Solana. A lot of people are excited about Aptos and Avalanche. A lot of people are excited about Ethereum competitors that they're launching like Monad. I'm excited about all of those as well. But Ethereum is the big dog. In my CIO memo this week, I called it the Microsoft of blockchains. Not the sexiest, not the most cutting edge, but Microsoft is the second largest company in the world right now. And billions of people use its service every day because it's trusted and reliable. I think that fits the definition of what Ethereum is and is maybe a good way to frame it.
And I think this also helps to articulate the impact here. Ethereum's column at 6,000 versus Solana at under 300. At the end of the day, it's the number of applications, the number of developers that are engaged that's going to make your blockchain grow. And so this I think puts it into really stark contrast for comprehension.
Yeah. This is something you saw earlier with the transaction count on the Ethereum ecosystem broken down between the layer 1 base chain of Ethereum itself and then that dramatic growth of the layer 2 ecosystem. The reason we put this in there is really that those numbers on the right, which explains what's going on, which is if you want to use Ethereum itself, the median transaction fee is over $4, costs $4 to do anything. Over this period, if you're using a layer 2, you could get that median transaction fee down to a penny on Arbitrum. If you're wondering why we're seeing so much growth in those layer 2 transaction layers, it's because I'd rather pay a penny than $4, right? And that doesn't mean no one's going to pay $4, because if you want that finality of settlement, if you want that high quality solution, the best of the best, you eventually have to post to Ethereum, and these layer 2s indeed themselves have to post to Ethereum. But what this tells you is that the layer 2s are really opening up this space, like blowing it wide open, because there's so much more you can do if your fee is a penny than if your fee is $4. It just opens up a huge landscape of applications. So I'm really excited about that. Great. Yeah, lots of slides. These are fun ones. This looks on the left at the top 10 crypto applications by revenue. This is a measure of applications built on Ethereum and the fees people pay to use those. And you can see different applications paying hundreds of millions of dollars in annual revenue into the Ethereum ecosystem. And I think that helps demystify a little bit what's happening here, right? Lido, Uniswap, a Coinbase competitor, contributing almost $1 billion in fees. When you wonder, why does Ethereum have value? It's because people are using Uniswap and they pay $1 billion in fees to do it, right? And that relies on Ethereum. On the right, it looks at the amount of money locked into decentralized finance protocols in the crypto ecosystem. The reason I included this chart, Rick, is that a lot of people think DeFi is dead. And the numbers just say you're wrong, right? It's almost back to new all-time highs. Activity on protocols like Aave are already at new all-time highs or approaching that. Uniswap is doing exceptionally well. DeFi like had a moment in the sun and was very hot, and then had a pullback, and people have forgotten to look at it. And it's quietly coming back at pretty fast rates. And we just wanted to highlight that there for people. All right, more, killer apps built on primarily Ethereum. This is looking at stablecoin market capitalization and transaction activity. Like DeFi, stablecoin market cap is almost back at a new all-time high. I think a year from now, we could be looking at numbers that are substantially higher than the $160, $170 billion in stablecoin AUM. There's talk of a stablecoin bill in Congress next year. I think this is a category that is exploding. And of course, stablecoins are built on Ethereum and other blockchains. So as they're used, it benefits those blockchains. And on the right, you can see that transaction activity is actually at an all-time high, which is a pretty remarkable fact.
It's really interesting because people keep talking about the volatility of Bitcoin and crypto, and what they fail to realize is how big the stablecoin market is, and how this is going to be the first focus of Congress in legislation, because it's, as you're showing here, hundreds of billions of dollars in assets in what is currently an unregulated market. And this is what's so exciting. The fact that Wyoming just announced they're going to launch their own stablecoin just shows how this thing is going to be everywhere for everybody pretty soon.
That is right. Just wait for Jamie Dimon coin. It's coming, Rick. The stable coins are a fantastic business, and they're also a major source of treasury demand. Stable coins are the 16th or 17th largest holder of US treasuries in the world if they were a country. They're almost systematically important. So they have a lot of bipartisan support. I think there's going to be a bill next year, and I think we'd be talking about $1 trillion, in relatively short order.
And this is why.
This is exactly why. Yes. I mean, look at those numbers. This is stablecoin transaction versus Visa payments, and they're not that far apart. This is incredible. I would point out, people wonder how this is. We have a lot of myopia here in the US. In the US, we're not using stablecoins day to day. Go to Argentina, go to Nigeria, go to other challenged countries that can't access dollars in the traditional banking system. Stablecoins are like a lifeline over there. They're getting huge use in adoption, and of course also used in crypto brokerage and crypto trading. But this is showing you that stablecoins can handle Visa-like transaction volume, and I think that's a pretty remarkable fact in and of itself.
People need to remember that this is a global asset, and we could argue as Americans, what's the big deal? Our financial system works fine. That isn't true in most of the world. And that's why there is so much interest in crypto and stablecoins beyond our borders.
That's right. Yeah, pivoting over into the crypto equity space. I know a lot of people want to allocate into crypto, but don't feel comfortable holding Bitcoin or Ethereum directly. What we're looking at here is the price to sales ratio and the 2024 estimated revenue growth of crypto stocks versus other major industry sectors and industries. And the message from this is twofold. We try to be transparent here at Bitwise. On the left, crypto equities are expensive, right? On a price to sales basis, they're trading at relatively high levels, not as high as real estate, but around the same levels that you pay for information technology. But on the right, their revenue is growing exceptionally quickly. And I think people miss this, right? Remember, Bitcoin's price is up 120, 130% year over year. There's a high correlation between revenue growth and Bitcoin's price itself. A lot of these companies are extremely profitable at this point in time and relatively attractive and potentially under-owned. So we just wanted to call that out with this slide.
And it's worth doing because as the price of Bitcoin rises, much of that growth drops straight to the bottom line. It doesn't, Bitcoin mining is kind of like gold mining in that regard. If your mining costs are relatively fixed, the price going up is just pure profit.
That's right.
And there you are.
There you are. Yeah. And these numbers are coming. What you're seeing here is the average price of Bitcoin in Q2 and the average cost to mine. And you can see, probably two things. One is that miners differ. Some have lower costs than others. That's worth keeping in mind. I don't think this is necessarily a sector where you can buy just without looking. But the second is that, this is a pretty profitable business on a unit basis. And importantly, as that price rises, as you mentioned, it's just pure profit falling to the bottom line.
So what do you account for the big disparity on the left versus the right? Why are some
Yeah.
miners spending more than the price of Bitcoin and others less?
A lot of it has to do with energy costs and when they arrange for energy costs and who has the lowest energy cost. And the other has to do with how recently they upgraded their equipment, whether they're using cutting edge equipment, which is much better unit economics. Those are the two primary factors, but we just thought it was worth calling out those differences. Yeah, ETP flows. I think this tells an important story, which is, there was a huge amount of pent-up demand for Bitcoin ETFs when they launched in the market in January. You can see pretty consistent only inflows for the first, few months on the market. That corresponded with the period where Bitcoin went up substantially. Since then, it's been more mixed. But I would put a caveat on that more mixed piece, Rick, which is that even though it's been more mixed, these ETFs have still been gathering billions of dollars in each quarter. I think they gathered $2 or $3 billion in this particular quarter of Q2. That's phenomenal for a new ETF. I really think, people may have been spoiled by that initial burst of energy. But of course, ETFs took 10 years to launch. Of course, there was pent-up demand. But if you look past that and you think, well, they've pulled in $4 or $5 or $6 billion since the start of Q2, that's actually like a record for ETFs. These are on track to be some of the most successful ETF launches ever. I think 2025 flows will exceed 2024 flows. Everything I'm seeing in the market speaks to that. And while there will be inflows and outflow periods, just like any other ETF, the net direction of travel is up.
And the big problem with this chart is that each column you see is a week. So it looks like a huge amount of time has passed. No, it hasn't. It's been about 8 months. So we need to remind ourselves that this is an investment designed for the long term, not the short. And so, just
I love that point. I love that point because we compare this to like the chart of flows into gold ETFs by year, right? We don't even have one of those candles yet. And if we did, it would be plus $20 billion, right? And I think that's a really good point, right? All right. Yeah, I love this chart. This is looking at the breakdown of the 13F filings for who reports holding Bitcoin ETFs. Now, an important caveat here is that 13F filings only tells you who holds Bitcoin ETFs if they have $100 million or more. So this is not accounting for the retail holders or for advisors with less than $100 million. But what you see from this, and this is old, this is Q2, is that they have relatively widespread adoption. Hedge funds have been big movers into this space. 60% of the 25 largest hedge funds in the world have exposure to Bitcoin. You can see that on the right side of that page. But investment advisors are coming along, right? 23% of 13F holders fit into that, another 15% into brokerage, and then a smattering among the other groups. I find these very optimistic. You're getting widespread adoption by institutional investors of this really new ETF much faster than you do in most ETFs. And that's what I take away from this one.
And what we're seeing is that once people and firms are investing, they're staying invested. They're not. I'm not seeing anybody exiting saying that's over, that's done. The way they're saying it about, for example, ESG. So this number is only going to rise. All of these numbers only going to
Yeah,
rise.
I think that's right. And you saw that from Q1 to Q2, and we'll see it again when the Q3 numbers come up. It's rising sharply. This chart is just to poke my old friends who love gold ETFs. Look, gold is doing phenomenally well. It's trading at a new all-time high, but there may be some substitution effect going on between Bitcoin and gold. And you see it here. The flows into Bitcoin ETFs have been extremely strong, and there have been net flows out of gold ETFs. I was just speaking with a major advisor at the Barron's event who was asking me if he should sell half of his gold and move it into Bitcoin. We talk to people all the time who build inflation hedging sleeves in their portfolios that are 50% Bitcoin and 50% gold. Some of that is being funded from gold sales, and I think you're seeing that in the ETP numbers.
And nobody's asking the opposite. Should I sell my Bitcoin to buy gold?
I have not heard that one yet. I have not heard that one. Great. Yeah, crypto venture funding. This is an interesting chart. I think it tells you two things. One is that venture funding is down from the peak of the last bull market. I mentioned earlier that I don't think we're in the building leverage, heavy VC investment, runaway bull market phase of the 4-year cycle. This chart should give you confidence in that. But actually, my most favorite part of this chart is comparing where we are today with where we were 4 years ago. Remember, crypto's historically moved in a 4-year cycle. So the right-hand side of that chart and the left-hand side of that chart are equal points on the cycle. Again, this is a reminder that this market is advanced a lot over the last 4 years. We're at a much bigger steady state. And also that we're potentially have a much bigger room to run on the upside as we get into that sort of overzealous period that we've seen in previous bull markets. Now we finally got here, Rick, to the portfolio slide.
And this shows you exactly the impact of that non-correlation.
That's exactly right. So this is looking at the returns of adding 1, 2.5, 5, 10% Bitcoin to a 60-40 portfolio of stocks and bonds. And if you look at the 2.5% line, which is probably the average allocation of a Bitwise client, it's no surprise that it boosted the return. Maybe you're surprised it boosted the return by 50 percentage points. That's pretty remarkable for a 2.5% allocation. But I would look 2 columns over to the annualized volatility column. And what you see there is adding 2.5% to the portfolio didn't change the volatility. You wouldn't even notice a difference between 8.55% annualized volatility and 8.93%. It's noise. And the reason for that is that even though Bitcoin is wildly volatile, if you have a volatile asset and you rebalance it, this is the result. And that's why you see the Sharpe ratio kick up over 50%. You don't see a big impact on maximum drawdown. Now, to be clear, if you're 10% Bitcoin, look at that vol number, right? Up 50%. There is a point where the volatility of Bitcoin really influences the portfolio, but the numbers most advisors are talking about, 1, 2.5, 5%, it's historically been a de minimis contribution, and that's what you're seeing in this slide.
And this is simply reinforcing the whole reason why advisors love modern portfolio theory. This is why we build portfolios the way that we do with broad diversification. And you're showing that adding a risky asset to the portfolio lowers the overall risk of the portfolio. It's exactly what Markowitz taught us, and this is just proving that point out. One important factoid here that I get this question all the time, I'm not sure why I do. When you add 1 or 2.5 or 5%, you're taking it from the 60, not the 40, right?
Mm-hmm. Yeah, that's what we see most people do.
And that makes perfect sense. This is, this is an ownership asset. So take it from the ownership category of stocks. So leave your bonds alone. This is how you allocate the equity portion of the portfolio.
Yep, I think that's right. This chart is missing its green shade. But
I can see it a little bit, but yeah, it's hard to see. Basically, since it is hard to see for most folks, you'll see it in the download. It's basically showing you in a graph what the prior chart showed you.
that is exactly right. And this is looking at rolling 3-year period of returns. The point of this is we weren't cherry picking data in the last slide. You could have held Bitcoin in any 3-year period in its history. And if you rebalanced, you boosted your risk adjusted returns. On average, you increased your returns by 23 percentage points. That's a 100% win rate for 3-year holding periods. Hard to find an asset that matches that. We get this question all the time. What about Ethereum? I love Ethereum too. And you can see the same results here. Now, historically, Ethereum has been slightly riskier than Bitcoin because it's newer. That shouldn't surprise people, right? If you did the first 5 years of Bitcoin's existence, you would have had even more volatility. And so you can see here that a small amount of Ethereum, again, boosts your risk-adjusted returns. It maybe has a slightly bigger impact on volatility, but even at 1%, you're not impacting volatility at all. You're boosting your Sharpe ratio by, 20, 30, 40%. Again, non-correlated assets in a portfolio context. It is what we were taught, 101 portfolio construction, and it's been a remarkable result. And this is that same rolling return period. The same thing is true here. There's never been a 3-year period where adding ETH to your portfolio and rebalancing didn't boost your risk-adjusted returns. And then, of
And
course,
this tells you the same thing with a combination Bitcoin and Ethereum. Just for the sake of time, I'll blow through it quickly.
Yeah, let's sit on this slide for 1 second. I get a lot of questions about correlations, and this is showing you the correlation between the S&P 500 and Bitcoin since Bitcoin launched. And the way to interpret this chart is that dark green band in the middle between 0.25 and negative 0.25 is a zero correlation. As you go up, it's a low correlation, then a moderate correlation, then a high correlation. For context, the correlation between domestic and emerging market stocks is like 0.8, which is higher than it's ever been for Bitcoin and the S&P 500. I use this because there is this one period where the correlation goes up. That was during COVID, when all that mattered in the market was what the Fed was doing. We had trillions of dollars printed, 0% interest rates. Tesla wasn't trading based on how many cars it sold. It was trading based on what Jerome Powell said. All the correlations spiked. Mostly they spiked to 1. This actually stayed relatively lowly correlated. In the end, this makes sense. It goes back to what we said. What drives Bitcoin is different what drives the S&P 500. So your native experience should be to expect it to be lowly correlated. And I think that just makes common sense and it fits the data.
Same thing with Ethereum.
Same thing with Ethereum. Here we compared it to the NASDAQ because people think of ETH as a tech asset. Again, it's a diversifying asset. We've actually done a study that if you took the NASDAQ 100 and then added 5% Ethereum, guess what? You significantly boosted your risk-adjusted returns, right? It is a diversifying technology asset. And then this slide, everyone talks about Bitcoin being volatile, and it is. And they wonder how it can be a store of value when it's so volatile, and I get it. But it's getting less volatile by the day, right? I know it's still volatile, but it's getting less volatile by the day, which is what you would want to see as this asset matures. It's still volatile, but much less volatile than it used to be.
And same thing is true of Amazon over the last 20 years. So as any new thing comes out, it's ridiculously volatile and uncertain. And as it matures, certainty rises, volatility decreases.
That is exactly right. This may explain one of the reasons that volatility is decreasing, and you mentioned this earlier, which is that institutions are coming to this market. It's really hard to find a major Wall Street firm that isn't doing something in crypto today, right? Whether that's Larry Fink talking about it weekly on CNBC, or whether it's Jamie Dimon, who's been publicly skeptical, but came out last week and said he has the biggest blockchain team in Wall Street. And then look across here, they have crypto trading, private funds, they're ticking every box. It is just the case that the institutions are arriving, and they're arriving at a rapid rate.
And when they do, get out of the way, because they're going to be bulldozing through this whole thing.
That's right.
And it's extending to Congress.
Yeah, this is a really remarkable result. This is
our last slide, by the way.
Oh man, we did it. This is looking at the vote on FIT21. FIT21 was a bill to create a new way to regulate crypto assets in a sensible fashion instead of the current push and pull between the SEC and the CFTC. And the important thing here is that it got both Republican and Democratic votes. Crypto is not a partisan issue. I know in the presidential election, it seems like it might be, but in Congress, you're seeing these bipartisan votes in favor of progressive crypto legislation, whether it's FIT21 or the SAB bill that passed or stablecoin efforts, there's an emerging bipartisan consensus that we want crypto to develop on US shores. And I know that there is a narrative in politics or in the media that that's not true, but these votes tell you that it really is. And I think, almost regardless of what happens in November, we're going to see significant progress in Congress on stablecoin legislation, on custody, and on other factors, and it's going to be positive for crypto in the future.
So, given all this, summarize all the charts into a single takeaway, Matt. What does all this translate to?
I think we're right on track. That's my takeaway. I gave a presentation to Barron's earlier today and talked about all the things that had to happen in order for crypto to establish itself as a new store of value, as a major technology. And we've ticked all those boxes. The price needed to go up, volatility needed to go down, institutions needed to come in. We needed to see progressive crypto regulation. All of those things are happening. That's the reason Bitcoin is up 130% over the last year. It's the reason it's the best performing asset this year. And as I look ahead toward the end of the year, I see things getting better. I see progress on the legislative and regulatory front. I see major wirehouses probably approving Bitcoin ETFs. I see more demand and no more supply. It makes me very bullish. It doesn't mean that it's not risky. Of course, it's risky. It's a risky new asset. It's volatile. But it does, for me, paint a very positive picture. Not a perfect picture. Nothing is perfect, but a generally positive upward trend picture that looks pretty darn good for the next few years.
The elephant in the room, of course, are the elections. So talk about what you see the impact of the presidential election in particular on crypto next year in a Trump versus a Harris administration.
Yeah, the first thing I'd say, the best thing that we can do with the election is get past it. I I mean that for crypto as well as personally, but I do think uncertainty hangs over the market. Markets hate uncertainty. There's some uncertainty around the election, and once that resolves, I think it will sort of release crypto to what I believe is a higher level in the market. In terms of the specific impact, look, basically for Bitcoin, I'm not sure that it matters that much. I think Bitcoin has escape velocity in the market. I think it has bipartisan support in Congress. I don't think it's going to have that big of an impact. I think in most scenarios, the election will be positive for crypto because I think we'll either get a split government or a Republican-led side. I think those will both be positive environments for crypto. I think if it's a Democratic sweep, I mean, I think there is some risk, particularly to altcoins, which have more regulatory risk around them. But the biggest thing is we want to get past the election. I think it has been hovering over the market. I think crypto is a little bit of a coiled spring waiting for November to end.
Yeah, I share your view. I think that if there is a threat, I'm not sure there is, but if there is one, it might be to companies doing business in the US in crypto, which has nothing to do with the price of crypto. To your point, whether you're Bitcoin mining in Denver versus Europe, you're going to do Bitcoin mining. So the companies may relocate if they had a draconian environment, but that wouldn't have an impact on the prices of the coins themselves.
Yeah, I think that's right. I would also add that when people think about this issue, what I find is that investors only see risk. So they're only looking at the risk and the downside. When I look at this issue, I see like a 90-10 chance of a positive direction. You have to think where we're coming from to where we're going. And in most of those scenarios, that's a positive upward movement. So I actually think there is more regulatory political opportunity that there is risk. Doesn't mean there's no risk. Of course there is. But I think people don't view it as two sides of the coin.
Yeah, I think you're right. Those incredible data, and there's more than what we merely showed in Bitwise's Q4 report that Matt authored. So we are sending you the link right now that you can use to access the report. You are also welcome to go to Bitwise's website directly, which is bitwiseinvestments.com. and you can access that report. Also, Matt's brand new weekly commentary where he talks about Ethereum and why, Matt, you believe that Ethereum is poised for price increase. And there's the link to it there as well for you in the chat box. So encourage you to read Matt's new weekly commentary on Ethereum, which I found really insightful, and the Q3 report, which has got all of the charts you just saw today, plus a ton more. This was terrific content and information, Matt. Thank you so much for sharing all of that as always. We have 2 more crypto webinars coming up in the next month. Next Wednesday, talking about those crypto equities, the Bitcoin miners and the chip makers and the financial services stocks that are publicly traded on the market so that you can engage in the crypto space via the stock market rather than buying crypto directly. And on Wednesday, October 9th, yield generating staking, lending and custody. We're going to talk about what is going on in investment opportunities beyond the spot ETFs. And if you are interested predominantly in the ETFs, which I believe you ought to be, we've got a terrific set of toolkits, one on Bitcoin, one on Ethereum, that will allow you to easily compare the charts. You'll see how well Bitwise stacks up to the other ETFs with a lot of really great content, educational information for you. They're free. They're available on that QR code. And as always, we encourage you to get your CBDA designation. All your sales staff, Matt at Bitwise, have gotten their CBDA designation. 18 CE credits, online self-study course that gives you the information you need to become fluent in this conversation. 5 different tracks. Take it at your own pace. And be sure to tune into my podcast every day, Monday through Friday, wherever you download your podcasts. Matt Hougan, CIO, Bitwise. Terrific content as always, my friend. Thanks for joining us today.
Thanks for having me. This was delightful.
Thanks, everybody.